Hello everyone and welcome to the Like a Tortoise channel. Before today's video, I just want to take a step back and congratulate all of the new joiners. No. Hello everyone and welcome to the Like a Tortoise channel. Before I delve deeper into today's video, I want to say thank you to all of you who have been following the channel. That tells me that you are finding a lot of value in what I'm saying. So I do appreciate all the support, all the of course, all the ongoing support that I can see, not just by the increasing number of subscribers, but also by the amount of comments that you guys have been lefting across the video. So big thank you. In fact, I try to respond to all of them. And I find many of your comments completely very telling. In fact, one of the recent comments, for example, which is one that I want to address, is a company for me to analyze, which is Align Technologies. So this is pretty good. I always ask you to give me feedback on future videos, and if you want me to put out more content regarding specific businesses, I will, of course, do that, provided that I find the company, provided that I find the company to be a good business, at least, right? It needs to be a company that marks many of the boxes that I'm after. So like a tortoise kind of investment, so to speak. But the one that was left here in the comments, I'm not going to say the person, but the company is Align Technologies. And I was looking at the fundamentals early this morning, and it does appear to be a good business. So I will create a video on this company, and let's see what conclusion we are able to draw. Okay, so what this video is about, the upcoming earnings reports. And if you know the companies that we are invested in ever since we made our portfolio public, then you know that 3 companies within the portfolio report this month, and that's why this is a big deal. So let me go back to the portfolio. Once again, I have nothing to hide. This is my performance so far. Let me minimize this. You can see that I started the portfolio about 2 years ago, almost 2 years ago, and this has been, a stellar performance. Let's not forget the S&P has been a phenomenal run. In fact, it has been going like this for many, many years now. But because I own higher quality companies that are priced cheaper, then it makes sense for this outperformance to continue. I'm not suggesting this rate of return will continue, but I want to continue to see outperformance. Otherwise, what's the point? You might as well just put your money in the index, right? So it's very good outperformance so far. That equates to 29% annualized returns, give or take, which is fabulous. And you can see that the 3 companies that are reporting this month are LVMH, which is my second largest position. Then we have PayPal, and in order we have first actually I think LVMH is the last one, but the first one to report is Evolution AB. Then we have LVMH, exactly, and then last but not least we have PayPal, which reports the 28th of October. So as of what I want to do with this video is I want to talk about the key reasons behind the stock market drops that we saw that we've seen over recent years across these names. And look, if you invest the way like a tortoise investor does, then you will buy high quality only when it's marked down. There are many reasons why the stock can go down. It can be macro headwinds, or it can be a company-specific reason, right? Or it can be a mix of both. And so let's talk about that. And let's talk about what I want to see, what I want to see in the upcoming reports. Okay, starting with LVMH, I believe the date of the date they are publishing. They are publishing the results is October 14th, but correct me if I'm wrong. And what are the main reasons behind the drop? First of all, it's not every day that you can find a company like LVMH well off its highs. To be more precise, 50% off its highs, which is exactly when I started buying shares. So I know that some people are saying, Ed, can I buy shares right now? Guys, I mean, you have to understand the business. You have to understand, once you have determined that what the business mode is, in other words, what are its main competitive advantages, then you have to be able to put a value on a company. Remember that value is based on the future cash flows that the business will produce. There are different valuation methods that you can follow, but you have to determine a value for the company before putting your money into it. Do that exercise, only then should you invest. And you can see that per my calculations, LVMH real value would sit between 800 and 700 euros per share. So, which means that I started buying with a significant margin of safety. As you can see, the average price was about 477, and I'm now in the green. But this doesn't mean anything because I'm a long-term investor, and so I'm not. Listen, nobody knows what the stock is going to do over the short to medium term, right? So what I care about are the fundamentals. So let's talk about that. But like I was saying, it's not every day that you see a stock like LVMH collapsing 50%. Okay, so what caused the stock price to collapse, and do I think this is a short-term thing or a structural problem that is going to significantly impair the company in the long term? And so let's talk about the key reasons behind the drop. Number one, we have softening luxury demand and cyclical drag. What does that mean? You know that for years, LVMH, there was a significant boom in the luxury space. First of all, for those of you who don't know LVMH, this one is the largest luxury empire in the world. They have brands, I think 70 brands, something like that, which is insane. And they do have an empire that covers wine, spirits, fashion, right? Fashion and leather goods. So they are essentially everywhere, even watches. And that's part of the reason why I decided to buy them, because they are well established. They have been around for a long time. The CEO, Bernard Arnault, is a phenomenal CEO, and this has been a stellar compounder. So I don't see any reason why this shouldn't continue to be the case going forward. After years of boom driven by strong consumption, especially post-COVID opening, there was a softness, right? So, for example, in 2025, beginning of 2025, LVMH net profit fell 22%, while operating profit declined 15%. That was significant. And then you can see that the fashion and leather goods, which is the main revenue contributor, about 49% to be more precise, saw a 12% decline in some recent periods. For all this reason, these have been the main reasons for the drop, in my opinion. But then, of course, let's not forget that China and the United States are LVMH's main markets. I think both combined essentially make up about 50% of the revenues, which is significant. And if you can see that there has been weak performance in China and Asia, excluding Japan, where in China and the rest of Asia, excluding Japan, that's about 30% of total revenue in where they get most of their revenue. And the matter of fact is that Chinese consumers have pulled back on discretionary, as you know, luxury spending amid economic pressures. They had their 2008 like financial crisis there with the collapse of Evergrande. And then Chinese and other international tourists, a key luxury buyer cohort, have been buying less, of course, hurting store traffic and cross-border purchases. And if you can see, if we go back to the charts, you can see exactly that. Look at that. Let's put the yearly revenues. Okay, you can see, in fact, it's a lot more telling if we just flip this to the trailing 12 months. We can even do the quarter, and you can see that revenues have come back down after a period of of boom, yeah, post-COVID, as you can see right here. So we are seeing some normalization right now. I don't think this is cause for concern, but it's something that we want to reassess going forward, right? So these are revenues. And then you can also see, for example, the profitability got hurt as well. Look at that, pre-COVID. Pre-COVID, it went ballistic. But then we are seeing, now that we are seeing some normalization, profitability got under pressure as well. All right. And so this is part of the reason why the stock has been facing selling pressure. Also, margin pressure, pricing constraints, and costs. Remember, tariffs are a headwind, right? So tariffs and trade friction pose challenges. Inflation, rising output, labor costs, logistics, they squeeze margin in luxury goods. That's and so on top of that, on top of all these problems, we had a high valuation, and so we are possibly seeing some mean reversion. What do I mean by that? Well, look at this. So look at this. If I check the P of the company, look at that. At one point, going all the way to 2020, we were trading at a P of 54. That was the highest. And then, of course, with the sentiment waning, we are now seeing and fundamentals deteriorating slightly. We are seeing we are seeing that premium fading out, right? So from 54 and 46 all the way down to 20. Yeah, so, and you can see, by the way, that even despite the recent rally, we are still trading at one of the lowest valuations from a price to earnings standpoint. All right, and the same. Let me have a look at the cash flows. I think this is important as well. I want to see the cash flows, the free cash flows. Yeah, I like that. Look at that. I mean, I don't think you can go wrong with this investment. It's just so even though they have been investing a lot, you can see that free cash flows are on the way up again. But let's look at margins, because that has been part of the bearish thesis that margins have been under pressure. Okay, let's have a look. So if you look at gross margin, you can see, look how consistent these gross margins are. I love this. That's a characteristic that you will typically only find in companies with a big moat. Okay, this consistency over time, even though there has been a slight decline, you can see that the average is 66%, and we are now at about 66%. So this is completely normal. Now let's check operating margins. This is where the problem is. A bit. You can see that, yes, operating margins have come back down as well from the highs, but nothing that significant to cause panic. In fact, we are still at 21% against an average of 21.67, trading at about our average. Again, some normalization here. And then if we go to net margin, we can see that these margins have been slightly under pressure as well. Because if I go here to the income statements, let's check the SG&A. Selling general administrative expenses, so costs with salaries and so on. This one has been rising as well. So it's something that I want to check. But I think management has been doing a very great job of controlling costs. In fact, they want to become more cost conscious, of course, and they have been implementing some cost cutting measures to give margins a boost, which is going to be important as well. So this is the main story for the reason. So this is the main reason for the price, and I think all these things that we are seeing that I just pointed out are going to dissipate over time as the economy improves. All right. And if it doesn't improve, guys, you have to understand that LVMH is one of the best positioned companies to absorb a lot of the impacts because they have pricing power. They have a well-diversified portfolio. If they struggle, imagine what competitors which are weaker, will suffer. Imagine how much they will suffer, right? So I wouldn't be surprised if there were more, if there were consolidation in industry, but we will see. As the Chinese consumer perks up and starts spending, I think this will create a very important tailwind for LVMH. Okay, so what about evolution AB? Okay, so the key reasons behind the drop include regulatory risk, licensing reviews. By the way, all these reasons, all these risk factors are important, and we're going to have to reassess them, no matter how great the company is. So, regulatory risk, licensing reviews. The UK Gambling Commission launched a review after discovering that Evolution's games were being offered via operators without proper UK licensing. In other words, yes. So you know that Evolution AB supplies its games, right, to casino operators. They are not a casino operator themselves. But what happens is that those casino operators didn't have a proper UK license. And that can create a problem for Evolution, of course. It's a reputational problem as well. And so this is something that Evolution is already addressing, and I like that, because otherwise they're going to have more problems going forward. And we have yet to determine whether they're going to be fines or if their license is going to be revoked, which I don't think it will, but there may be some fines here, okay? Now, Evolution has proactively restricted, which is called ring-fenced, availability of its games in markets where regulation is weak or where a lot of revenue was coming from unregulated operators not licensed. Why is this a big thing? Because they are doing this especially in Europe. They are doing this in Europe, and Europe is a major contributor of revenue. And so what happens is that profitability and revenue got hurt substantially, exactly because of these self-imposed steps that that, in my opinion, will create short-term pain for long-term gain. All right. This means that by doing this, they of course this is very good, because if they don't implement these measures now, they will have to implement them down the line, and that's going to create problems, right? So what we are seeing is that management is actually front running these issues by taking measures to avoid them, to avoid any similar problems in the future. So I think this is a good thing. Slower growth, disappointing quarters. Okay, so modest revenue growth. This ties into what we were just discussing here, against the backdrop of all these regulations and self-imposed measures. Revenue has slowed down, so profit declines in certain regions. Margins are slipping, in particular North America growth, while positive was weaker than many analysts expected and versus industry growth. Europe has seen declines, in part due to regulatory constraints. So nothing new here. Remember that this is a company that used to grow at 30-40% per year. And now they are growing at 3 to 5% per year. I mean, in profitability has inclusively seen sharp declines. So for a company that used to grow this fast, of course, if you were buying at the top, now you are hoping and praying that the company goes back to where it was. That's why no matter how fast the company grows, we want to invest always with a margin of safety. And last but not least, reputational risk, cyber attacks, stream piracy issues in Asia. Asia is the most important market where they generate most revenue. So if Asia is not growing, of course, revenue is going to suffer. And that's been the case. And it was only recently that we started seeing some growth in Asia, which is very, very good. It means that the countermeasures they are implementing to combat cyber attacks are playing out, and that is very, very important. Okay, an important note. Some of the headwinds are likely structural, 100%. For example, regulatory tightening all over Europe, higher expectations for compliance, increased enforcement, these are all likely structural. Why do I think this is good news? Because one of the key reasons that stops investors from investing in a company like Evolution, which is also in a sin industry, right, gambling industry, is the fact that they generate a lot of their revenue from unregulated markets, which is something that is starting to shift as a growing percentage of the revenue is now coming from regulated markets, which is a very healthy transition. But still, we want to see more regulation because that will attract outside investment, and that means funds and all of that. Okay, so Evolution is adapting, but its slightly new normal won't be as easy growth or margins as in early years. But because I believe the current prices are already discounting a lot of this pessimism. And last but not least, let's talk about PayPal, or as many people are calling it now, PayPal. Key reasons behind the drop: slowing growth in core branded checkout transaction volume metrics. This was the main reason for the decline, even though the company reported positive earnings last quarter, the stock still declined because analysts saw a slowdown in the branded checkout. So one of the biggest red flags is that branded checkout growth, payments via PayPal and Venmo. So when you go and pay with PayPal, you will see, if it's branded checkout, you will see the logos, right? And so what happens is that growth has decelerated. In quarter 2 2025, total payment volume grew 6%, but branded checkout grew only 5%, and this was enough to keep investors on edge. Investors who have been very impatient with PayPal, if you ask me, but this was one of the main reasons. Okay, changing business mix and pruning low margin vanity growth segments. I love this approach by management. What did Alex Chris do the moment he became CEO? He decided to exit or reduce unprofitable low margin business lines. Why? Because former management only had these businesses for the sake of revenue. But that is short-term thinking. That's not sustainable over time. We want to see that the company is actually exiting these low-margin business lines, even if that hurts revenue in the short term, because that will create that will generate more profits over time. So focusing more on branded business. Some commentators believe that pulling away from volume in those unbranded plumbing operations may shrink reported revenues, even if long-term health improves. I don't agree with these analysts. In fact, this would only make sense if you think short-term. But over time, I think this will create. I think this will be very beneficial for PayPal, and this tells me that management has a long-term investment, has a long-term horizon, and they are willing to sacrifice revenue in order to put the business, in order to how to call it, in order to flesh out a lot of these unprofitable and low margin businesses. Okay, margin pressure and interest rates. That's another reason. So PayPal earns, one of their business segments is the buy now, pay later. So they earn interest income from balances held or invested and from lending credit products. What do you think will happen when interest rates decrease? Because now we are shifting, the Federal Reserve is lowering interest rates, and the fear is that as they lower interest rates, that will impact the interest that PayPal earns on those balances. Okay, so that, I think, my opinion is that can create indeed a headwind, but I don't think it's a major cause for concern based on all the other based on everything that the company is doing and all the partnerships they are creating in the new revenue lines that they are putting in place, which I think are going to be very, very bullish for PayPal over the next few years, right? Guidance, forward expectations versus investor skepticism. Even in quarters with decent results, PayPal has been met with skeptical investor reaction because of somewhat cautious forward language. So the previous management was putting out all these bullish, was always providing very bullish forward guidance, and then they will fall short. They won't deliver on those exuberant expectations. PayPal, with under Alex Chris, is doing the exact opposite. So they are being more cautious, but they are always exceeding their own expectations. I love that. Okay, even if Wall Street is not happy. Okay, I think this is exactly what you want to see. Chris knows that there is work to be done, and they want to be cautious, cautiously bullish, so to speak. And so after, for example, after quarter two, the stock dropped 9% despite an upgrade to full year guidance, which is true. So this tells you how much impatient market participants are and how we long-term investors can greatly benefit from that by working all this nonsense to our advantage. The market seems to demand more surprise upside or confidence in sustained acceleration. And when results come in line or slightly ahead, expectations already priced in leave little room for satisfaction. So another factor right here. Ultimately, guys, what I really care about is this. So if I show you PayPal, in fact, let's go right here. And I showed you this in previous videos. But if I go right here, look at that. Let's flip this to trailing 12 months. In fact, annual. Let's go to income. Look at this. Revenue continues to go up, right? Even despite even against the backdrop of management's measures to eliminate some of those low margin businesses, which hurts revenue. You can see that revenues are still growing, even if slightly, but you can see that net income is also going up. You can see that shares as outstanding are going down. In fact, PayPal has been buying back shares like there's no tomorrow. I love that because it increases our share. It increases our share, right? So our slice without us putting any more money to work. So I love that. And look at free cash flows. Okay, they are now sitting at 5.29 billion, but management says that by year end this should go back to 7 million. If that does happen, 7 billion, sorry. If that does happen, that would be incredible. And you can see that ever since Alex Chris took over, the free cash flow has been on the rise once again. And if I go to ratios, look at that. ROIC is going up. Return on assets is going up. Return on equity is going up. So the company's capital allocation is becoming more effective, even though the company is still spending spending to grow the business. Okay, I'm very happy with PayPal. In fact, I think PayPal is setting itself up for a big turnaround, and I am very convinced that Alex Chris will be able to deliver on the strategy. So, guys. Let's wrap up this video right here. I hope you found it insightful as always. And if you did, please smash the like button and share it with other people that you know can learn, that are passionate about the markets as well, can't make any money. And so because the way we do things here is we take one step at a time, and we don't care about noises. We don't care about technical noise. That's just noise. Over the long term, price will follow the evolution of the company's fundamentals, and that's what matters. All right. And let me know what other videos you want me to record, and I will, of course, do that. And have a great rest of your day, and stay tuned for more. Okay. And once these companies report earnings, I will then create videos on those earnings reports and tell you what I'm doing with my portfolio. Cheers, guys. Have a lovely weekend.